You basically forecast for non-OPEC plus supply are robust for now. Are you worried that the low oil prices will, of course, hurt supply growth? How long do you expect these prices to stay and impact the rest of the market?
Good morning, and thank you for that question. Yes, so with prices at the current level, there's a lot of concern about the drivers for that and the slowing demand growth. But as you say, we are expecting non-OPEC supply growth of about 1.5 million barrels a day this year and next, and the U.S. being the biggest contributor to growth, but joined by Brazil, Guyana, Canada. So this American quartet, these four countries, adding more than 1 million barrels a day of supply. Of course, the concern is the shale patch most responsive to prices, that if prices dip and stay at these lower levels, activity will slow in the United States. But that's not something that we're seeing at the moment. We would really have to see lower prices sustained for some time to see that impacting activity levels.
Toril, does the slowdown actually make you think that peak demand could arrive even sooner than expected?
So the numbers that we forecast now, we're expecting oil demand growth globally to grow by about 900,000 barrels a day in 2024. And this is in line with our expectations since we first published our 2024 growth forecast more than a year ago. Oil demand growth is returning to normal levels after the post-pandemic surge. But we are seeing slower growth in China as the economy is cooling, but also as electric vehicles and efficiency gains eat into demand for road fuels and for aviation. And it's confirming our view, as we put it, we expect a peak or a plateau in oil demand for the end of this decade. For the time being, if that would be move ahead, it's too early to see. But we feel confident that moving forward, we see slower oil demand growth than we have seen in the past.
Do you think it's time, given all that's happening at the moment, for OPEC Plus to concede that its output cuts are just not working and therefore increase supplies?
Of course, at the moment, we also have significant outages in Libya. Production has been taken offline, so that's something to watch very carefully with and how that evolves over the coming months. But it's for OPEC. I'm sure that OPEC are also watching these indicators very closely, and they will adjust production as needed moving forward.
I mean, the drop, and you mentioned the Libyan output, the drop in Libyan output seems to be fairly mild at the moment. Do you expect that to decrease further in coming months?
We're hopeful that there will different factions in Libya will come to a resolution and agreement so they can restore production and exports. For the time being, our current assumption is that production will gradually increase over the course of September and October. But of course, this is something that we would have to watch and see.
Has a plunge in oil prices, do you think, Toril, been excessive?
Of course. We're seeing the market focus is moving from the third quarter when we had very tight crude markets in particular. Global crude oil stocks declined by more than 70 million barrels in July, and we see continued declines in August. So the market has been tight, physical market has been tight, but we're seeing product stocks increasing as demand is weak. So there's definitely weakness in the product market and demand, but now the focus is moving to the fourth quarter and to 2025, where in the fourth quarter we're expecting, barring any prolonged outages in Libya, we're expecting market to be relatively balanced. And in 2025, we're looking at significant surplus in the oil market as oil demand growth continues to slow, and with robust increases from non-OPEC production, even given the current production cuts from OPEC, we can see a significant surplus in the market of oil next year, and that's what the market is focusing on.
Toril, overall, why do you think your, the demand forecast is so much lower than others in the industry? What are you seeing that others aren't?
We're seeing, we have the firm data, actual data for the first 6 months of the year and preliminary data for July and August. And we're seeing that the first half of this year, global oil demand growth grew by 800,000 barrels a day. That's compared to more than 2 million barrels a day in the first half of 2023. So the data corroborates the slowdown in oil demand as we have expected for quite some time. Mobility indicators also confirms that the post-pandemic rebound in mobility in China and elsewhere has run its course. So we're returning to more normal rate of growth. Our projections for this year, they're in line with the relatively subdued expectations for global GDP growth of 3%. It's in line. So, and we're seeing now that other forecasters out there are adjusting their forecast downwards month after month and coming closer in line to our own expectations.